What is up, my people? Happy Friday and happy 1st of November. Can you believe it? We are rounding the corner. It's pretty much a wrap, I think, this year. Although, don't stop hustling. We want to keep going the rest of the month. We still have this month and we have December, right? A lot of things actually happen, believe it or not, in December. So keep going. I'm starting something new. Every Friday I'm going to do what I call education moments. So Uncle Ed will be talking about all kinds of stuff about finance, right? And I wanted to start sharing that because for those of you who don't know, I have a little over 36 years of finance experience. Been in the mortgage business almost 24 years, and so there's a lot to talk about. And as you know, there's a lot been going on with the economy. First thing I want to talk about today is why are rates going up when the Fed lowered rates? So let me decipher this, because when the Fed, meaning Chairman Powell and all of the Federal Open Market Committee, talk, they're really talking about short-term rates, and specifically what is called the federal funds rate. It is the rate at which banks lend each other money literally overnight. It's super short term, but we're talking about a lot of money, of course. That's what they're talking about. And what does that affect? That affects your short-term rates, things like credit cards, right? More so on auto loans, equity lines of credit if you have an equity line of credit for your home, those kind of things, because they're short-term rates. It does not have a direct correlation with mortgage rates, but of course it does affect it because the markets in general do affect mortgage rates. Now, why have mortgage rates been going up? It's because right now the Fed and the economy is really just focusing on jobs. And if you look at the jobs are still there. We looked at what is called the BLS, the Bureau of Labor Statistics report came out today, Friday, November 1st. And even though we were supposedly going to create 112,000 was the number, 113,000 jobs. We only created 12,000, and that's because of the hurricanes, and also we're seeing strikes going on with the unions and things, so that has affected a lot. But the reality is that the jobs market is still pretty robust, and as long as the job markets are robust, guess what happens? People are employed, and what happens when they're employed? They spend. What happens when they spend? It raises prices, right? Which is why we're seeing so much. Our eggs are going through the roof, right? I think it's like an 82% jump on the prices of eggs, and believe me, I eat a lot of them, and so I'm seeing it as well as you are. But the reality is that we're seeing mortgage rates going up. Now, are they going to continue to go up? I think there's going to be at some point where they're going to start to go down, because the truth is inflation, we have pretty much tamed inflation. Not that can't change in the near future, but the reality is we have tamed inflation, and the unemployment rate remains at 4.1%. So that's where we're at with that. The other thing I wanted to talk about today, and really the point of this video, was about investing. So many people look at, well, how do I invest my money, right? First thing they think about is their 401k at work, and that's great. But my first question is, do you even know what kind of investments do you have in your 401k? What's in it? Most people go, yeah, I have a 401k, but do you know what's in it? What kind of investments? How are you allocated? How are you diversified, even within your 401k? That's super important. Which, by the way, leads me to, do you have a financial advisor? The fallacy is that financial advisors are really only for the rich. No. Financial advisors are really great one, will help you build wealth. It's not just for the rich to build more wealth. As a matter of fact, the financial advisor can help you with that 401k to tell you, are you properly diversified? Have you embraced asset allocation correctly? All these things that are super important for the growth of that portfolio. But more importantly, here's what I believe. The first step to investing is not actually investing your money. It's tracking your money. Do you know the difference between a budget and tracking your money? Think about what I just asked. Do you know the difference between tracking your money and a budget? So tracking your expenses is what? That's an activity. But budgeting is a discipline. Guess which one comes first? Yes, that is tracking your expenses. When was the last time you tracked every single penny that you've spent in the last 30 days? To then go back and analyze it to see where is your money going. I recommend, and it's something that I've been using for well over a decade, there's an app called, of course there's an app for everything, right? It's called Expensify. It's free. I've had it for free for over 10 years. It is fantastic. So here's what you do. You download it. You're going to track for the next 30 days every expense. I don't care if it's Starbucks, right? Or it's stamps, groceries, car payment, mortgage, rent, whatever. You're going to track every single penny. You're just going to track it. You're going to input it into the app. Forget about it. Do not change your habits yet. So don't cheat. Track it for 30 days. And after 30 days, because this app allows you to put these expenses into categories. For example, if you go to Safeway, you go to wherever your grocery place is, you're going to put groceries, right? That's a category. Meals and entertainment, auto, household expenses, right? Those kind of things. Subscriptions. We all spend money on some type of subscription, right? You're going to put all that in there. So at the end of 30 days, this app allows you to look at every category of expense, and you're going to divide those totals by your total gross income that you made that month, because it's going to give you a percentage, right? It's going to show you what percentage of your total gross income is that individual category. And I think you're going to be shocked by what you find, because I know I've done this and I was shocked. And then you're going to create a budget around that. So for example, let's just say that ratio, for example, let's say you spent, I don't know, $1,000 for meals and entertainment. I'm not saying don't have fun, but maybe $1,000 a month is a little bit too much for you, right? And what you want to accomplish, because maybe that $1,000 a month really should be maybe $200-300 or maybe $500, but you can use that other $500 to what? Open up an IRA, put that money into the 401k, invest in whatever you're going to invest after you talk to your financial advisor based on your goals and how much time you have and how aggressive or not aggressive you are when it comes to investing, right? You're going to start to find that money and you're going to make decisions. That's what a budget is. It's a discipline. You're going to decide that you're going to start to taper off on things that are not conducive to the very goals that you want to achieve. Use that money. It's powerful stuff. And you start making decisions that you're not going to eat out as much, or you're not going to do as much as this. You're not going to rob yourself completely, but you're going to start to taper off and use the opportunity cost of that money to invest in your future and things that are conducive to your success in the future. Making sense? Whether it does or not, please reach out to me. I'm always here to help. Free consultation, anything you want to talk about when it comes to finances, whether it's mortgages, you want to invest. Look, I'm not a financial advisor anymore. However, I can point you in the right direction because I know thousands of people. And I'm not talking about just thousands of people, thousands of awesome professionals who put you first. Have a great weekend.